All right. Hello, everyone. Welcome to another episode. I am your host, Shane Carter, Hampshire Capital. And today, just wanted to create a quick video and talk about the 7 reasons that you should passively invest in real estate. A lot of people do top 10, top this, top set. We boiled it down to the top 7 reasons. And I'm going to go through them one by one. And in no particular order, there's not one that's more important than the other. Here are the top 7 reasons to passively invest in real estate. Number one, cash flow. In most investments, you do not get cash flow, right? If you buy stock, if you buy equities, you're really just sort of waiting for that company, that accumulation of companies that you invested in to appreciate. But in real estate, we get monthly and quarterly what are called preferred interest payments. So our real estate investors get cash flow from the asset. The asset produces income. We pay off the expenses in the asset, and then monthly pays off the mortgage, and then we have the excess, and that is the cash flow from the asset. That cash flow gets delineated to our passive investors first before we as the owner, operator, sponsors can get any cash flow at all. So you get your money before we get any of our money. And that keeps us very much, our feet to the fire, so to speak, to ensure that we're managing the asset as tightly as possible. So number one, cash flow. You get cash flow from your investment, generally anywhere from 6, 7, 8, sometimes even 10% annually in terms of what you would get for just the cash flow part. There's more. Number two is equity, which is the second piece that you get. So again, the multifamily community that we own, it produces income. The residents pay their rent, and we pay the expenses on the property. Then we pay the mortgage on the property. So we're paying down the debt, or more precisely, the residents are paying down the debt on the property every month. And so we are gaining equity. Now, there are some loans that are interest only for a certain amount of time, et cetera. But in the long run, which we take the long view game, we're talking about 3, 5, 7 years of holding an asset, we are paying down the mortgage and we are actually gaining equity in the asset via the residents paying down the mortgage for us. So number two, equity. Number one, cash flow. Number two, equity. Number three is the appreciation that you get on the asset itself. So over time, in general, multifamily assets and real estate in general appreciates, and it appreciates due to a number of different market conditions. Now, let's say, for example, we're filming this, towards the end of November 2022. We are in an inflationary environment. We have interest rates that are high. Has all real estate gone up over the last 6 months? No. But again, if you take that 3, 5, 7 year window, where one of my favorite quotes in real estate is, you only lose money in real estate if you sell. If you don't sell, then you don't lose. You just hold on to that property and you pick the right time to sell. And that's when you make a ton of appreciation. So number three is appreciation. Number four, which is timely right now, is it sort of ties in with why multifamily assets have been appreciating, will continue to appreciate at a non-pro rata fashion, is inflation. So inflation is, everybody says, oh, inflation's bad. Obviously the costs of goods and services go up. The gas is more, eggs are more, milk is more, bread is more, et cetera. So when is inflation good? Well, inflation is good if you have debt. And that is going to be one of the next ones we talk about, is debt. However, inflation works well when you have debt, because the inflation essentially devalues the dollar, and it devalues your purchasing power today. That's what inflation does, right? That's why things cost more. However, if you have 75% leverage or less on an asset, and you have that interest rate at 2, 3, 4, 5 even percent, but inflation is 7, 8%, Well, you're now making an arbitrage on that because the value of that debt is diminishing while you're also bringing in additional dollars today. So the inflation and owning assets in an inflationary environment is very, very much a positive for the bottom line, because you're using future dollars to pay down deflated values of debt today, which is a huge leverage point. And so right, the other one is, of course, the leverage, right? The next one, number 5, is leverage. We place leverage on these assets when we buy them. What does that mean? So we take out debt. We buy an asset for, so let's just use simple math, $20 million, and we'll get debt for $14 million, let's say. And then the other $6 million will brings our money, raise passive investors' money, and we'll put together that $6 million. We'll buy the asset. So the $14 million in debt is really a cheap payment, right? So we're utilizing debt in an intelligent way to raise the value of everyone's investment, because that debt payment is fixed. When the asset is appreciating, we're paying that debt down with the tenant's rent payment every month. The asset's appreciating, we're gaining equity, and we're utilizing the principle of leverage to replicate our money much, much more quickly than you could, for example, if you buy Apple stock. So if you go to buy, a share in Apple, I'm not quite sure what it's trading at today, but let's say you go to buy a share in Apple, it's, whatever it is, $300, let's say, right, for a share. You can't use leverage to buy that. You have to put the whole $300 down to get your share. So you're essentially giving a one-to-one exchange of dollars today for that interest in that equity. But in real estate, we use leverage. So that same purchase power goes up by 3x because you just use 60, 70, 75% bank leverage at very low interest rates to acquire that asset and to acquire the value in that asset. And so that is a very, very powerful principle that we use in investing and in real estate. And as a passive investor, you get to benefit from that. And so number 6 is again just the passive nature of this. So that's one of the other benefits of investing in real estate is there's active real estate investing and then there's passive real estate investing. And the difference is in active real estate investing, you're signing on the mortgage, you're managing the asset, you're whether vacation rental or duplex or quad, whatever you're buying, you have to deal with the tenant issues. You have to deal with if this person doesn't pay, if a toilet leaks, if the roof leaks, if the tenant's children leave the tub on and the water leaks down through the ceiling and damages the unit below. That's on you. You've got to deal with that. You've got to fix it, deal with the insurance company, deal with the tenant, deal with contractors, getting everything put back together, fixed, etc. It's a lot. I've done it. I obviously still do it, right? But if you're new to investing, or even if you've done that, you realize that's a lot of work. And there's a lot of liability. Again, you personally signed on that debt. You have to personally handle that, or you're paying a property management firm, but they're taking a good chunk of your money away. In passive investing, you come into an investment with us as a limited partner. So you enter an investment as a limited partner. That means that your liability is simply limited to the dollar amount of your investment. That's it. You have no other liability. You're not liable for the debt on the asset. You're not liable if there's a slip and fall lawsuit, or if there's a dog bite, or all these things that I've personally had happen on assets through my career. And so as a limited partner investor, you get to invest passively, but you still get all the benefits that we just went over. You get the cash flow, you get the appreciation, you get the depreciation. Actually, sorry, that's the 7th one is the tax benefits. But you get the principle of leverage. You get all of these benefits without any of the headaches. The operator and the sponsor deals with all those headaches. They sign the debt. They deal with the tenant issues. They deal with contractors. They deal with insurance matters. They deal with the lawsuits. They deal with all of the things that happen in real estate investing. And number 7, which I just alluded to, is your tax benefits. So real estate is one of these amazing vehicles where you get amazing tax benefits, and one of the major ones is depreciation. So you get, as a limited partner, you get a K1, which is a partnership level return, and we do cost segregation studies or bonus depreciation studies on just about all the assets we buy. And what that does is allow you to have losses that you can use towards your other passive income. So most of our investors are, um, have passive income from other sources, and you can use that, the passive losses that you get as an investor in one deal, to offset your passive income that you have over here. That is an extremely valuable tool, very, very powerful tool. And again, is one that is another benefit of real estate. Of course, if you are active in real estate, then you can actually offset some of your active real estate income with passive losses in income as well. So there you have it. Those are the top 7 reasons why investing passively in multifamily real estate is intelligent. Any questions or otherwise, always feel free to reach out, Hampshire.capital. And that's all for now. Thanks so much for listening, and we'll see you on the next one. Take care.